It seems like a lifetime ago, but it's only been 2 years since the global pandemic broke out and the world economy was on the verge of collapse. Policymakers threw everything, including the kitchen sink, at the economy to keep it afloat. One of the policies that they resorted to was quantitative easing, that many observers have credited for the relative quick economic rebound. Whether quantitative easing was indeed the silver bullet that saved the world economy or not, starting this month, the Federal Reserve, the U.S. Central Bank, has started quantitative tightening. What does quantitative tightening actually mean? And what would be the effect for stock, bonds, the dollar, gold, Bitcoin, and real estate? I'm David Wu, a former Wall Street macro strategist with a 20-year track record of making actionable predictions about major global change. Welcome to The Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. Before we begin, come subscribe to my free YouTube channel and get notified when a new video comes out. So what is quantitative tightening? Is it simply the opposite of quantitative easing? Let's quickly review how quantitative easing actually works. Your wealth consists of financial assets like stock, bonds, and mutual funds, non-financial assets like real estate, and money. Money is the cash that you have in your pocket and the deposits in your bank account. Money is different from the other assets that you own. It generates little to no returns, but you need it to pay for things that you buy. That is why most people still must have some money, even if they don't own any stocks or bonds. Because you can convert money easily into goods and services, it is what we call the most liquid financial assets. So how much money do Americans hold? Well, U.S. households in aggregate hold about $45 trillion of stock, bonds, and mutual funds, another $45 trillion in non-financial assets consisting mainly of real estate, and about $18 trillion of cash in bank deposits. That means about 11% of the balance sheet of U.S. households is just money, versus 28% in stocks, bonds, and mutual funds. What does money have to do with quantitative easing? Quantitative easing is when a central bank decides to drive up the prices of the financial assets that you own by changing the relative supply of assets and money. How does it do that? Well, simpler than you might think. In most cases, by buying government bonds from you or from the mutual funds that you own and paying for them with money. The idea behind quantitative easing is that when suddenly people find themselves sitting on a lot of money that generates little returns, they will want to take more risk by buying stocks, riskier bonds, and real estate. When everyone decides to do this at the same time, it will drive up the prices of financial assets. Central bankers think that by making you wealthier, you will spend more money on goods and services and help support the economy and help create jobs. Now let's turn to quantitative tightening. This is when the central bank tries to drive down the price of financial assets by selling to you its holding of government bonds that you pay for with money. The idea is that when you end up with less money than you would like, you will likely rebalance your portfolio by selling some of your stocks, riskier bonds, and real estate. And this will drive down the prices of these assets. Why would a central bank want to make you poor? They do that only when the economy is doing too well, so well that they want to slow down the pace of spending and job creation in order to keep inflation under control. On March 15, 2020, the Federal Reserve embarked on a massive QE, the scale of which the world has never seen. Between March 2020 and March 2022, in the space of just 24 months, the Federal Reserve bought nearly $5 trillion of U.S. government bonds and mortgage bonds. As a result, broad money supply, that is currency in circulation plus bank deposit plus money market funds, commonly referred to as M2, increased by $6 trillion. That is 40% during this period. With the Fed having already cut short-term interest rates to zero so that people were earning next to nothing on their deposits, the demand for risky assets like stocks, corporate bonds, and even crypto assets soon began to outstrip supply, driving up the prices of these assets. The greatest irony about the pandemic is that it unleashed the greatest wealth creation the world has ever seen. Household net worth in the US climbed from 700 to 800% of average disposable income in just 2 years, mainly reflecting massive capital gains on stocks and properties. It was no different than if money had been suddenly growing on trees for people who own stocks and properties, not to mention cryptocurrencies and any other vehicles of financial speculation. These assets became very overvalued, whether they were bonds, stocks, or properties. For example, as I pointed out in another video, House price to income ratio in the US has now surpassed the level that we saw before the 2008 housing crash. Even after the recent correction in the stock market, stocks are still very expensive based on historical valuation. However, the important takeaway is that stocks are not expensive based on where broad money supply is. Indeed, the ratio of stocks to money supply is within the range of the last 20 years. In fact, nothing is more important for the outlook for the stock market than the outlook for money supply. And it follows that how far the Federal Reserve goes with quantitative tightening is of paramount importance for both financial and non-financial assets. The Fed is expected to raise short-term interest rates by 50 basis points at its June meeting, another 50 basis points at its July meeting. After that, the market is currently expecting the Fed to raise interest rates at a clip of 25 basis points at each of the next 3 meetings before the end of the year. At the same time, the Fed says that they're going to start reducing the bonds that they're holding. In other words, they plan to sell back some of the bonds that they bought during the quantitative easing back to the market. Well, starting on June 15th, they plan to sell $47.5 billion of these bonds every month in the first 3 months, and then to double the pace of selling to $95 billion a month from September. All in all, they will sell $600 billion of bonds in the remainder of this year, another $1.1 trillion in 2023. This means over the next 18 months, they will have only unwound 30% of what they bought during the pandemic. However, the pace of unwinding is still faster than during quantitative tightening that occurred in 2018 and 2019. The impact of quantitative tightening on the economy and financial assets should be viewed in conjunction with the fact that, 1, the economic sanctions against Russia have driven up both US gasoline price and natural gas price to their all-time high. This is eroding the real purchasing power of US households. This and strong wage growth are also eroding the profit margins of US companies. Even without quantitative tightening, we are very likely to see an outright decline in corporate profits in the coming quarters. Globally, the continuing battle between China's zero-tolerance policy and the highly contagious Omicron poses a downside risk to global growth and upside risk to global inflation. Meanwhile, a global food crisis and rising debt servicing costs are threatening to drive many developing countries to the brink of recessions and political instability. Will quantitative tightening be the straw that breaks the camel's back? I'm inclined to say yes. 6 weeks ago, I predicted that we will be in a recession before Thanksgiving. I remain very much of that view. If I'm right, the correction in stocks and speculative crypto assets is far from over. A recession will be bullish for gold, but I think the drainage of liquidity by the Fed and other central banks will be a headwind for gold in the short term. I continue to think that the real estate market is vulnerable, even though I think the low inventory will prevent a 2008-like sharp adjustment. If you got something out of this program, please hit like and subscribe to my free YouTube channel. If you want to learn more about my investment strategies, please come visit us at davidwuunbound.com. Thank you for listening.